Great. Good afternoon, everyone, and thanks for joining us today. Our team had productive in-person meetings last week in Las Vegas, and we are excited to share our takeaways with you this afternoon. Some quick housekeeping items. Please note that this presentation is being recorded and will be publicly available on our website for a period of time following the presentation. And some of our comments today may contain forward-looking statements. Please refer to our SEC filings for information about related risks. When we open today's discussion to Q&A, those on the screen, please feel free to ask questions verbally. Everyone else can use the question and answer functionality at the bottom of their screens. With that, I'm going to turn the call over to Jim Taylor, our CEO.
Thank you, Stacy, and thank you, Stacy and Jack, for organizing this call. I guess this is our virtual download of the first in-person conference that ICSC has had since 2019. This is typically the December conference, which from a deal-making perspective, historically has happened in New York. We did hold it in Vegas. The attendance was real strong. I'm going to let Brian talk a little bit about the numbers, but all in all, a very positive event for us. We're joined today, of course, by Angela, whom you all know, and Brian Finnegan, our Chief Revenue Officer. We also have on the line Evie Gross, the Director of National Accounts, Steve Kaufman, Senior Vice President of National Accounts, and Laura McLaughlin, the Director of Specialty Leasing. So without much further ado, I'm going to turn it over to you, Brian, to sort of talk about what happened.
Yeah, thanks, Jim, and thank all of you for joining us for our second virtual ICSC download. We're looking forward to getting back to doing this in person, hopefully in May. But as we talked about last May, our team's got a lot of great feedback from the conference last week, which exceeded all of our expectations. As Jim mentioned, typically the December conference for ICSC, it's the second largest show that they have across the country. And the goal for ICSC was really to exceed that attendance, and they did that. They were close to 10,000 attendees that were registered last week. The list of retailers, core tenants that we were growing with, and new tenants across the portfolio was long. Our team had very productive meetings over the few days that we were out there, over 300, with a smaller crew than we would have typically brought. And what was particularly encouraging about it was just the sheer depth of retail demand that we had across the board. Again, both from core tenants who continue to perform well, those in the value apparel, grocery, QSR restaurant space, as well as some new concepts, which we'll touch on here shortly. The other thing I would hit on, and we're going to go through I'll highlight a few things about the conference, some momentum that we had going into it, and then you'll hear from Evie, Steve, and Laura in particular too. We haven't had a great opportunity to speak to you all about our specialty leasing program, but it's a huge component of our business, and we were able to move some things forward within that group last week as well. And then we'll also open it up for some questions from the audience. But briefly, just heading into the conference, we came into it with a lot of momentum. As Jim talked about on our last call, our productivity was rivaling what we were seeing in 2019. And what's particularly encouraging about it is because of the depth of demand to be in our centers, we're driving significant rate improvement over what we had seen pre-pandemic. We're signing leases at the highest rents that we ever have. And so that competition for space, the demand to be in our centers because of the investments that we made across the portfolio is really coming through, or has come through in our leasing results. Particularly a category that we've highlighted that we continue to have a great pipeline with is in the grocery segment. Through the third quarter, we had signed 13 new grocery leases since the start of the pandemic. We had another 20 or so in the pipeline. And what came out of the meetings last week was just a number of tenants that want to co-tenant, continue to co-tenant with grocery. And whether that's grocers in the specialty space, the traditional space, ethnic segments, we heard a number of retailers. One in particular was a discussion that we had with Williams-Sonoma, who was talking about how well the stores are performing in locations that they've opened next to the likes of Whole Foods and Wegmans. And we continue to see that as a strong co-tenant for us with a number of the retail concepts that we're working with across the board. And again, our pipeline in the grocery segment is as strong as it's ever been. Jack, you want to go to the next slide? And as I mentioned, our core tenants continue to have robust opening plans, not just for 2022, but we were having discussions into 2023 and 2024 as well, particularly those in the off-price segment. Across the board, Ross, Burlington, TJ, they expect to be the beneficiary from an inventory perspective in terms of some of the supply chain issues that have come up. You've seen that in some of their results, and it's really driving a lot of performance and expectations as they go into next year. There's still parts of the country where there are significant voids, and as we talk through a number of opportunities across the portfolio, they certainly have robust store opening plans for next year. The other thing I'd hit on here, two tenants, is in our out parcel segment, which probably we have the most demand out of any size range that we have across the portfolio. The likes of Chipotle, Chase, and other QSR restaurant operators, financial institutions. It's been a big focus of our reinvestment pipeline is our out parcel program. And many of the folks on the call today, Steve, Evie in particular, as we're working through renewal discussions with some of our larger tenants, we continue to free up those opportunities. And it's been something that they've been very receptive to and part of the discussions that we had last week. And the last group of tenants that I'd mention on this page is fitness. We've seen a rebound in fitness, particularly in that low-cost provider segment and also in boutique fitness. The quality of the franchise operators, the traffic trends that they're seeing in terms of people coming back to those operations has been pretty encouraging with those trends as we head into 2022. That low-cost provider segment seems to be a good complement to some of the at-home fitness trends that have stuck. And it's if you look at our overall fitness exposure, which is about 5%, a big chunk of that is in that low-cost provider segment. So we were pretty encouraged by some of the trends that we were hearing there. Jack, you want to go to the next slide? And then we also continue to see opportunities with new retailers to the portfolio. Looking at the right, those are just a handful of the new tenants that we've added here over the past couple of years. You look at it in terms of the categories, we continue to see good demand from better quality restaurants. We talked about that on our calls and in forums like this in the past. People are just demanding better restaurants and better services in the suburbs. So as we look, we added our first new lease with Chopped in our Newtown development, our first new lease with Mezza in an out parcel development that we also have in Philadelphia. And we're continuing to see better quality QSR restaurants across the portfolio. Our traditional tenants are working on new concepts. Pop Shelf in particular, we signed our first lease with them over the summer. We have a number of other opportunities. They're going to grow that chain to 1,000 stores by 2025. And we had a number of discussions with them last week as they expand their footprint, not just in the Southeast, but in other parts of the country. And then Laura will touch on briefly too, how we're converting some temporary concepts into permanent concepts across the portfolio. And then as it relates to the mall native brands, that trend's continuing to accelerate. We've got multiple leases out with Skechers, Bath & Body, and Foot Locker. And again, continued to hear from tenants last week about their off-mall program, picking up tenants like Journeys, who we had in the booth last week, with some potential opportunities for them across the portfolio. Jack, can we go to the next slide? And then lastly, we're really lucky to have Laura on the call today to talk through our specialty program. It's a huge part of our business, and it's not just for us about driving ancillary income opportunities from the parking lots or from other parts of our portfolio that are not just filling space. For us, it's about innovation, because some of the innovation and the tests that we're seeing in the specialty leasing space are trends that also come into our long-term leasing. I mentioned some of the conversions that we've done. You saw Jay McLaughlin there on the screen. We're also we tested some things out with Skechers before we did long-term leases with them. We just opened a test for a Lululemon store at our Newtown development as well. And we continue to see those short-term opportunities turn into long-term merchandising upgrades in our centers. And then also trends like ghost kitchens. We were rolling out mobile kiosk ghost kitchens starting during the pandemic, which is really accelerated across the portfolio. Same thing with a lot of things related to our ESG initiatives, like electronic car charging stations and solar roof panels across the portfolio. Laura's been doing a lot with digital signage as well. So there's a lot within the space. The business continues to grow. As you've seen that, we've grown the business by over 33% over 5 years. That business actually grew during the pandemic as well. So we're continuing to see a lot of different innovation across the space. So with that, why don't we talk to our team and not just hear from me about last week, and I'll open it up to the group for some questions. And as Stacy mentioned, you can type in some questions here or raise your hand as well as we go through, because we definitely want to get some feedback from those of you that are on the phone and here with us on the screen. So Evie and Steve, why don't I start with both of you and maybe talk about some of the feedback that you heard in your meetings relative to demand from your tenants, maybe how that's changed a little bit since we got together virtually in May and over the course of the year. So Evie, you want to start?
Yeah, nice to meet everyone. Thanks for having me. So I would say the biggest change from the virtual conference in May is that at that point in time, retailers were looking to fill their 2021 pipelines and looking for immediate needs for deals that were maybe put on hold during the pandemic, but still somewhat unsure of the future. I think now that the growth and the return in traffic to stores has been solidified in their minds, and I had a lot of demand from my retailers looking not only to fill their 2022 pipelines, but looking out to 2023. In particular, Bath and Body Works, as well as Hibbett Sports, were all looking for 2023 deals. So that's great to see. And also a lot of the omni-channel strategies that they put into place during the pandemic that are now going to be here long-term, like buy online and pick up in store. They've seen the pickups from those strategies for their bottom line, and they're looking to capitalize on them going forward, and just really robust expansion plans.
Awesome, Evie. Steve, how about from your end? Steve, you there?
Yeah, I'm right here, Brian.
Oh, okay, got it.
Good afternoon, everybody. The optimism shown at the show from all of our retailers was really, really impressive. Demand from our core tenants was very, very strong. I would say that since May, like, the uncertainty has decreased, and the lights are on, and all the retailers now are open. And so the meetings that we had in Vegas were with multiple retailers, our national accounts, and they are game on, lights on. The retailers that we met with are all investing capital into their four walls. They're super razor focused on occupancy costs. They are looking out 3, 4, 5 store counts to open up new stores in markets. The tenants are spending a lot of money inside the four walls. I was really impressed to hear how much money is being spent both inside the box and outside the box as well. But I think because now everybody in the real estate world can travel, that full teams are assembled and they're ready to make deals. They certainly came to Vegas to make deals.
Steve, I think that's a great point. And just for the broader team, Steve covers two of our three large off-price concepts. And Steve, maybe you can just touch on from a trend perspective in terms of the flexibility and the discussions relative to getting stores open faster, because I know sitting in your meetings that came up a few times.
Yeah, okay, Brian. So with so many stores all of a sudden coming through the pipeline, tenants that have scopes of work that need to be done for delivery purposes, the tenants are all understanding of what's going on in certain parts of distribution for fixtures, for air conditioning, and more than many said to us that they were willing to work with us to delay, they wouldn't delay opening, but they would postpone putting in brand new units and certain things that they require as a part of scope of work for their occupancy. I would say the main focus, the question that we heard over and over and over again was, when can you deliver? When can you deliver? Because they have big expansion plans, not only for 22, but 24, 25.
Yeah, I think the one meeting we were in, the comment was, we're buying, that we had with one of those operators, which was great. Evie, maybe in terms of your tenants, where did you see some of the most demand? Was there a certain merchandise category? You cover a broad range of uses across the portfolio. Was there a specific tenant or a merchandise category that you would hit on?
Yeah, Brian, I would say that the beauty category and at-home category, like we're seeing a lot of demand from Bath and Body Works, with people staying home, and their candle division, the White Barn candle, they've seen a ton of growth in that, and all of the new stores have that new prototype. And then sporting goods and athletic apparel with Hibbett Sports, that category is on fire. As well as boutique fitness. Like you mentioned, I work with Exponential Fitness, which is the parent company for about 10 different boutique fitness operators. We're seeing them not only expand in their existing categories, but also acquire new brands and new modalities in the boutique fitness realm, as well as last mile distribution and micro fulfillment retailers like DoorDash's concept with DashMart. Seeing a ton of demand there.
That's great. Steve, anything to add from your end there?
Yeah, I would just say, the consistent theme from all the nationals for like tenant priorities was to be, open and operating and find locations in, well-located, high traffic, well-managed shopping centers with favorable co-tenants that drive sales through their doors. And we heard more than a few times how wonderful our redevelopment program is within Brixmor. And we're out in front of our retailer regular basis, and they've really responded well to our redevelopment program. Going forward, there's certainly a big, robust pipeline for that.
Yeah, and I would just add from my perspective, what was encouraging too is, again, some of our core retailers that have new concepts or are expanding some of the smaller concepts that they have within their fleet. So for instance, TJX really expanding where they're moving their HomeSense brand, or expanding Sierra Trading Post. So from a growth perspective, that was really encouraging to hear from them. And then again, back to Pop Shelf, you think about for a smaller concept brand that really just started a year ago, expanding outside the Southeast and taking that to close to 1,000 stores in that 10,000 square foot size range, which there continues to be a great deal of demand, as Evie mentioned, from health and beauty operators like Ulta, from the Five Belows of the world. So not only creating more competition in the 10,000 square foot space, but also as footprints change for some of the off-price operators and they go down to 20 to 25,000 square feet, we're finding those operators being very good co-tenants to be able to split, say, a 30 or 35,000 square foot box. It was interesting to hear that there were separate meetings just between the retailers alone to be able to come in as partners to take a piece of those boxes. So back to the flexibility that Steve was talking about, we heard that in a number of the meetings as well. Why don't we bring Laura into this from a specialty leasing standpoint? Laura, maybe if you could just expand on some of the trends that I touched on, what's changed a little bit from your perspective, and then if there was anything specific that came out of last week as part of those trends.
Sure, great, thanks. So I've really seen a major shift over the past handful of years from, like you said, Brian, the parking lots to moving them to our inline tenants. And what that allows us to do is activate our shopping centers with local businesses or brands that are testing these new concepts. You mentioned the Lululemon pop-up. We also work with Dick's Sporting Goods on the warehouse concept, which is a temp to perm concept. We met with them. They did about a dozen locations last year and are expanding. We did our first lease with them in Naperville this summer. Also, we are seeing the electric vehicle locations. They have a huge demand to install the infrastructure across the portfolio. And that's one thing we hear, whether it be from the SG side, pop-up, or the temp to perm specialty leasing umbrella. What our portfolio offers is the ease of the access to multiple communities and markets, and having a program dedicated with a team throughout the country where we can offer them the ease and the speed to market with a quick form and also a directed point of contact.
Great, and maybe expand on that. What makes, Laura, as you see it, because you're marketing 400 centers at once and talking to some operators that are expanding nationwide, what makes the specialty leasing program, our specialty leasing program, attractive to both some established concepts as well as emerging ones?
Sure, I think it's the partnerships that we have with our established retailers, as well as having the access to the various communities. We can work with one contact across the national portfolio, which allows them to evaluate our properties and know that what's right for in the Philadelphia market may not be the same concept that we're looking at in the Florida market, but we can work through those negotiations together alongside our national leasing partners and our local permanent partners. I hear from retailers all the time that they didn't know this is an opportunity. And then Brixmor has actually gone a next step, and we've actually V-boxed spaces that we can offer. So we can activate the shopping center prior to getting that permanent lease, which is unique to our program.
Yeah, and just to expand on what Laura's talking about is we'll put a little bit of capital to work and basically construct a white box for a tenant, and we may have multiple uses, or we did this at Newtown and enable us to bring Lululemon into the property, so we kind of get ahead of that there. Why don't I open it up to the crowd to see if there's any questions, either from those on the screen or from the investors here. Why don't we start with Paulina? I see your hand raised there.
Hello, everyone. I'm curious about Omicron. Do you hear retailers talk about Omicron at all? Of course, store opening plans are a little more long-term in nature. I hear that they are thinking about opening stores in 1 or even 2 or more years. But what do you hear on the floor about Omicron? Has it been a concern? Are they incorporating that at all in their decisions today or not?
Yeah, I can go first, Paulina. I didn't hear in our discussions anything related to concern from a pickup, either an Omicron or from the pandemic in general. Most of it was they were go forward discussions. I would say that where it came up in terms of footprint is the need from a broader range of tenants that don't have it today to allow for curbside pickup. And for instance, with Chipotle, adding Chipotlanes wherever they can across the portfolio, that was part of the discussion in most of the meetings that we had, because I think what retailers have found is they have a playbook emerging from the pandemic in terms of how they've been able to manage through things. So in terms of the footprint, that's what we heard. And then back to The only other piece related to that would be to Steve's point in terms of how some of these issues may slow down the ability to get stores open and how we can partner with retailers to be able to move those faster. So where we can get work started faster on spaces, how we can sub out different materials, whether it's the type of the HVAC unit or what the material that goes into the facade that we may be able to get a little bit faster. I think from that perspective, those were the two items that kind of came in related to the pandemic. But Steve or Evie, any additional feedback from either of you?
As I mentioned earlier, they certainly are willing to work with us, and they have the same priority as us. They want those stores open. So they're changing their playbook a little bit in order to be flexible to get the stores open and working with our folks, across the country, really. And it's always how soon can you deliver the space? So they're willing to, if you will, bypass some of the normal practices to open a store.
And I just add that from some of the mall native retailers, I think that the pandemic may have sped up their plans to locate in open air shopping centers like our own. And I heard some of them say that for their 100 stores that they're looking to open in the next 2 years, they would like as many of them as possible to be in open air shopping centers.
Okay. Great. Why don't we go to, I had a little technical difficulty here in terms of my video, but I'm still on the phone. Why don't we go to Todd next?
All right, great. Thank you. A question on the demand from grocers. It sounds like there was a fair amount of demand and conversations that you're having. Do you have a sense of how much growth in units or maybe aggregate square footage is required today based on the demand that you're seeing? And then historically, grocer demand would sometimes kickstart some new development. I'm just curious if there are any signs that shopping center development is beginning to pick up a bit.
Well, I'll take the first part of the question in terms of just overall demand. I would say where we're seeing it the most, Todd, continues to be in that specialty and value segment. So the likes of Whole Foods, the value operators like Aldi, Sprouts in particular.
You're muted, Brian.
Sorry, I got back on. They continue to have strong open to buys within that segment, and are talking about, again, stores for not just 2022 but 2023. On the traditional side, the likes of Publix continues to go into new markets, and you heard that they announced going into Kentucky. They're still looking to expand outside of their core footprint in the Southeast into places like Virginia, and we've been very active with them. We're about to open another redevelopment that we've got with them in Southwest Florida in Venice. So I think from that perspective, we continue to see a lot there. So there definitely is demand from grocery across the portfolio, both with infill as well as new markets. And then in terms of new development, I mean, a lot of these smaller operators typically weren't the catalyst for new development. And we haven't heard in terms of the size range. So we did not hear much at the conference related to them or any new trends related to new development. And, from a traditional standpoint, it's still a smaller footprint of a number of those grocers that are expanding store count, like Publix in the Southeast and H-E-B in Texas and such. Jim, I don't know if you have anything else to add there.
I think you've hit it. I just might also add that, retailers generally are looking at going into proven existing retail locations. They're looking to fill in, not necessarily go into greenfield type development. So we haven't seen it. That's not to say, Todd, that if this demand doesn't continue, that you all start to see it in certain markets and certain locations. But by and large, really beyond grocery, including grocery, the demand by retailers is to go into existing centers with proven traffic.
Thanks, Todd. Why don't we go to Greg next?
Hey, good afternoon. So I guess what I'm trying to figure out here is pre-COVID grocery wasn't terrible, right? Off-price was doing pretty well at the same time as well. So has there actually been any shifts in tenant demand, maybe heading into the new year, or is this just more a vision of less weak tenants that you need to backfill, right? So occupancy overall looks better from that perspective, or sorry, leasing overall.
Maybe I can hit that first, Brian, and fill in. But Greg, I think what's most striking to me is the breadth of demand. If you were to sort of compare pre-pandemic versus post-pandemic, those categories were doing well going into the pandemic. I think the pandemic proved their business models, proved the importance of a physical location near the customer, and maybe answered for once and all the central role the store plays in a multi-channel strategy. And what you didn't hear in the meetings that we had was some of the conversations around internal allocation of capital at the retailers, e-channels versus physical stores. It was all around physical stores. And as Steve Kaufman noted, not simply new store counts, but also investing in the existing stores, adding additional services, that type of thing. So I would say that the demand environment that we're seeing right now is actually much better than where we were going into the pandemic.
Great, thanks.
Thanks, Greg. Why don't we go to Floris?
Excuse me. Thanks, Brian. I had a question. Maybe if you guys can expand on the specialty leasing a little bit more. Specialty leasing is not something that typically gets broken out in a line item, so it's harder for the sell side and buy side to really understand and get a sense of the magnitude. And in the mall business, it can be call it 10% of your NOI, or Macerich has even said up to 15% of NOI. But and that business obviously in the mall space, it's easier for us to understand because it's the kiosks, it's the billboards, obviously the temp leasing as well. It's a significant part of the profitability of the business. Walk us through the specialty leasing, because unlike in the mall business where you actually control all of the common area and you can actually put kiosks in there without having to go to the local government to ask for permission, how do you guys activate and monetize some of the excess land, particularly around, you have a lot of excess land in your parking lots typically. How do you think about that? And can you walk us through some of the initiatives besides you mentioned billboards, how big that can be, and quantify that for us as best as you can, Brian or Jim?
Let me start. Floris, for our business, generally, specialty revenue is a lot smaller segment of overall revenue. It's low to mid single digits. It's not like what you see in the mall space. And then maybe to your last point about how we're monetizing parking lots, the most long-term and durable way that we're doing that is through out-parcel programs, through entitling additional land for complementary uses. I hesitate to say mixed use, but clearly, there are other uses, senior housing, student housing, multifamily, that we can entitle on our sites. And we're very active doing that so that we can harvest that much more significant value. But specialty revenue plays a critical role in our business, both in the temp to perm program that you heard Laura and Brian talk about, as well as activating some of our centers. And we are increasingly finding ways to monetize digital signage and other ways to give, retail concepts presence, if you will, in a physical way near where their customers live. So that's been something that we're excited about seeing. And then, additionally, as Laura mentioned, we're seeing significant demand from EV charging concepts, whether it's Electrify America or EV Go or Tesla or any of these. And we're very encouraged by the competition that's emerging for having charging stations at centers like ours in the improvement in economics. We're seeing rapid improvement in those economics in terms of how we can monetize those smaller portions of our parking lots. Brian?
Yeah, I actually was going to hand it to Laura too, to expand upon that a little bit, and then I can jump in.
Sure. Yeah, happy. Hi, Flores. So one of the things that we do in the common areas is definitely focused on community-centric events. So it could be a farmer's market. If we don't have a grocery anchored shopping center, there are oftentimes that the grocery anchored shopping center will allow for us to do both because they activate themselves as well within that spread. So it might be local artisans, and then the grocer is the farmer's market aspect of it. We also look and we reach out to the community with the small business associations to see if there's any use or needs. It could be a Christmas tree lot, which is more like typical to the open air shopping centers, the fireworks tents and this tent events. And then, as Jim mentioned, the electric vehicle charging station is really one that we're pursuing, as well as digital signage, which is a little bit longer term, but it offers a lot of opportunity to the tenants to activate and benefit from that value from having the vehicle charger stations out front or a digital signage where they can have that last point of contact with the customer before entering the space to do some advertising.
Laura, can I ask, can I follow up a question on the EV? Because I think that's actually a really interesting concept. I mean, there's, is there at some point that we see every shopping center in the country having an EV a charging station? And you mentioned there are multiple people that are looking to expand into this, obviously Tesla being one, but now that we have multiple EV producers as well, you're going to have multiple charging points. But presumably, is there going to be a difference in, I'm just thinking about the iPhone issue and changing plugs, and how compatible are they? And would it be possible to have, do you need to have 3 separate EV chargers in one center, or would one basically capture everything? Can you walk us through that? I don't know the answer.
Yeah, it's going to be a big, I'll try to summarize it as best as I can because you can get very technical. But the genesis of the EV charging program back in early 2000s, you did have to have multiple operators. Now they're universal. So you don't have to have Tesla to operate Teslas. You can have Electrify America, EV Go, Volta. I mean, the list goes on and on, how many partners that we do have out there. A lot of it is driven through the government initiatives, as well as the car manufacturers themselves that are going to work with all the partners. There's not one primary partner that we have that we would need to work with to be able to facilitate those vehicles. They're all pretty much universal now. It's based on the speed. So there are the lower speeds, which you have a longer dwell time, to the high speeds, someone could charge for 15 minutes and get a full load. So it can, like I said, it can get very technical. Sorry, did I cover everything, Flores?
Yeah, no, you did. Thanks, Laura. I'm just but so we could think about, in 3 years time or something like, I don't know how long it takes to roll all of this stuff out, but going to the grocer, charging up our electric vehicle or and then driving back home or driving to the city or doing something. And that could all be possible. And then we can go charge at another shopping center closer. If I'm living in Connecticut, driving to Manhattan, charging it in Manhattan, then driving it back and charge it with a full charge as well. Right.
Yes, that would be the infrastructure they're trying to implement right now.
And does that mean that your lease with whoever the operator is that going to be backed by the government, or is that going to be based on the credit of that?
It's definitely based on the credit of the partner that we're working with. And we do make sure that we're facilitating locations that are going to encumber our tenants. So they're going to be within the customer area, but it's going to be not prohibiting any type of out parcel development that we may be interested in, as well as access to the tenants themselves. So there are a couple of financial options out there. There's partners that offer to purchase the equipment. There are, a blended model. So it really depends on who you're working with, what they're offering, and what's right for each individual entity. So it's not just, Brixmor doesn't have one model that we work with. And I would say that our partners probably have different models as well, meaning the REIT partners.
Okay. Thanks.
Thanks, Laura.
Thanks.
Can I just add, Brian, we do provide disclosure on the specialty business overall. So it's labeled as ancillary and other rental income on the NOI page in the supplemental or in the same property disclosure. It's just under $14 million year to date.
Yeah. Thanks, Angela. And that was just the last thing I would add before jumping to somebody else is a lot of what Laura's talking about, it's extremely flexible. And one of the interesting things about the program is it continued to grow during the pandemic. And to Jim's point about long-term reinvestment opportunities, we're able to drive income with a lot of the stuff that Laura is doing while we work on longer-term plans. And it's been something that the team's really expanded on, particularly in those reinvestment properties across the portfolio. Why don't we go to thanks, Laura. Thanks, Laura. Why don't we go to Derek?
Hi, everybody. Thank you for having me on today. I guess the question, as we sunset the pandemic era, are there any changes in the utilization or methodology for assessing percentage rents? Enclosed malls are expanding the use, but I actually thought local retail was trying to move further away from percentage. I mean, partially due to BOPIS and e-commerce fulfillment sales being harder to capture. Any insights you can share, on the utilization of percentage and how you're looking at it?
Yeah, Derek, percentage rent is a smaller part of what we do in the open air space. We don't get as much sales reporting generally. I mean, our team's done a really good job of adding that across the portfolio, but percentage rent is going to be a smaller portion of what we do. We haven't seen the clause dramatically shift in terms of, nor have we had tenants come to us and try to redefine what that means in some of the older leases that says a sale that's made at the store, right? While that's a pickup, we can make the argument kind of either way. So from that perspective, we haven't seen a material shift in terms of that language changing from an open air perspective. Steve, I don't know if you have anything to add there. You're on mute.
No, I think you hit it right, Brian. I concur with what you said.
No, that's great. So we're not seeing any meaningful shift with the leasing demand that's coming today. So then just quickly, secondly, the retailer and tenant watch list has really never seemed so washed out. When you look at the next couple of years, how do you feel about tenant health today versus historically levels? And are you expecting more stores to open over the next 1 to 2 years versus close? And especially given, your portfolio? Thank you.
I'll take the last part first. Absolutely. I mean, it's the expectation that it's been reported this year that there's more store openings than closing. The watch list, to your point, Derek, is as small as it's ever been. Angela's talked about this on prior calls. It's something that we've been laser focused on. We actually improved our underwriting process over the course of the pandemic, but our retailers are a lot stronger today than they were before the pandemic. And as we look out, we feel really good about the underlying credit quality of the retailers within our space. If you are thinking about categories that we're still looking at, obviously entertainment and movie theaters in particular, we've seen some positive trends here in the third and fourth quarter related to the movie theater industry in terms of traffic coming back in some of the larger scale releases, but remains to be seen. It's a really small percentage of what we do, though. It's less than 2% of our ABR overall from an entertainment perspective. But I think there's more to come there relative to some of those entertainment concepts. Angela, I don't know if you'd have anything else to add. on
Well,
that.
I think that's exactly right. Obviously, 2020 was a relatively sizable bankruptcy year. We cleaned out through liquidations, really, many of the tenants that had been on the watch list for a long time. And then we've seen just continued positive trends on the tenants that, remain or were on our watch list kind of at the beginning of the pandemic or beginning of 2020, as they've had, good kind of fundamental trends in the business from a sales perspective. And they've been able to monetize some of those gains through, equity raises or other balance sheet improvements. So we feel good about the watch list going into, kind of early next year, which is the seasonal bankruptcy period, and don't see any significant risk for major, national retailer bankruptcies. But in addition to that, and Brian sort of touched on this, you're also just seeing sort of normal course move outs at lease expiration being much lower than usual. So our move out activity, outside of sort of the big credit events, but just general move out activity is also running well below 2019 levels, something like 20% below. So a lot of good fundamental trends in terms of tenant disruption.
I would add just one thing to Derek's other question about store openings and pipeline. I think just in general, the retailers have really upped their game. They're investing a ton of capital into their stores, their existing stores, as I mentioned earlier, both inside and out. They're fully staffed. That's the one thing that's really pretty amazing at the, in May, and now we're here. The big companies, the nationals, they're fully staffed in the real estate departments. They are strategic and focused and looking to grow, and they have 3- and 5-year business plans to open new stores. The other thing is retailers have spent a lot of money on technology, more than I can ever remember. So that's really been a big improvement in what they've been doing since the past.
Great. Thanks, Steve. Thanks, Derek. Why don't we go to Ki Bin?
Oh, thanks, Brian. So I think the message is pretty clear that you're seeing a lot of good demand across the portfolio. But I'm curious about the opposite. Like, where in the portfolio are you seeing less incremental demand, and are there any commonalities?
Less incremental demand. I would say, look, the large format, there's not many, over 50,000 square foot boxes that are out there. We don't have many of them to begin with, but that tenant base is fairly small. I would say you are starting to hear more from the likes of Target, and as I mentioned, the H-E-B's, Publix of the world in terms of bigger stores. But if anything, that larger retailer that's taking down 50,000 square feet, there's not as many of those. But having said that, because there hasn't been a lot of new development, retailers have gotten really flexible and creative in terms of how they're splitting up boxes. So and what frontages they can take, how they can work with loading. They've done enough Kmart boxes today that they have an understanding, or even splitting a Steinmart or splitting an office supply box. I think they've gotten fairly creative with that. So while those maybe larger to take one large space aren't there, it's how we've been able to, and how retailers have been able to get creative within that space has certainly improved. That answer your question?
Yeah. So there's no other commonalities in terms of like geographic region or type of center, or if you're like anything like that?
No, look, obviously the Southeast has been really hot activity. It's been strong, but we've had activity across the board and across the board. Strong grocer activity in the Northeast and the Midwest. Our California portfolio continued to bounce back very, very quickly. And what's been encouraging from us is how broad-based the demand has been, even if we've had pockets like the Southeast where we've had an outsized amount of growth. Evie, I don't know if you have anything to add on that on your end.
Yeah, Brian, I work with a lot of the franchise-based concepts. So I'm seeing demand across the portfolio wherever they can sign up qualified franchisees, and I'm seeing them get a lot of their existing franchisees who have the operating background and the capital and the wherewithal to continue to grow, to open new concepts and new locations, but across the board.
if I can squeeze a couple quick ones here. How often is shrinkage coming up in the conversations now? Is there a bigger demand from retailers asking the landlords to provide more security? Is that, or am I just watching too much news? And second, how would you peg the labor shortage issue for your tenants? Like, are they back to, like, how close are they back to being fully staffed at a store level?
I'll take the first one first, and it's certainly a concern. It's something we were very proactive on last year during a lot of the social unrest that we saw in May and installing stealth monitoring, looking at places where we needed additional security and putting those measures in place. But it's certainly a concern. We haven't seen a material uptick in our portfolio, but in talking to tenants, we had heard a couple tenants talk about closing locations on Michigan Avenue. It's certainly something that they're focused on, but again, something that we were very proactive with and continue to focus on maintaining a safe environment at our assets, and really across the portfolio. Great, thanks, Ki-Bin. Why don't we go to Anthony? Put your hand up for a while. Sorry there.
Thanks, Brian. Appreciate it. Question on the Bash Mart. Seemed interesting to me that you're signing leases there. Could you maybe talk about the size of the boxes, the terms of the leases, and maybe the potential size of that kind of business in the portfolio?
Yeah, I'll take that and let Evie jump in a little bit here. Look, as we're seeing some of these last mile distribution concepts pop up, they're not going to work everywhere. You know, we're really focused, and if you look at the core tenants that are expanding on creating strong daily needs traffic to our shopping centers and a good merchandising mix and a good co-tenant mix. Having said that, there's an opportunity, particularly when we do chop up a box and we might have some space at the back, to be able to put one of those operators in and have them pay close to a market rent for what otherwise would be a challenging, maybe a storage space. So we've seen that across the portfolio. Some of the size ranges that we're seeing from those type operators are between kind of 5,000 and 10,000 square feet. It's been fairly broad-based in terms of the places with that we're looking to co-tenant. And again, Anthony, for us, it's not like it's going to fit in every shopping center, but as we specifically look at demising boxes where we might have some of that leftover space, we feel like it could be a compelling add to the center.
And are these like 1-year leases, 2-year? Again, I guess how flexible are they for the tenant?
It depends. I mean, we've done some that are as low as a year. We've done some 3 to 5.
Got it. Okay. All right, thanks.
Thanks. How about we go to Connor next?
Yeah, thanks, Brian. I guess, so with the new focus on like digital privacy, using like Apple's new policies as an example, that resulting in limited data being shared with advertisers, have your tenants mentioned in discussions whether they've seen basically the benefits of having a free marketing with the storefront and then an increase in foot traffic that could be attributable to the decreased online advertising and shopping?
To be honest, Connor, that really hasn't come up. You know, where we get our traffic data from, you know, large companies that have that data's, we have no insight into the individual data of that, but we use traffic data a lot. But in terms of some of the shift that you're talking about from a privacy policy perspective, it hasn't come up in any of our discussions in terms of impacting consumer adoption or anything along those lines.
Yeah, okay, thank you. And then I guess just another quick one would be the fitness tenants have been mentioned a couple of times, and I was just wondering, going back to kind of past rent collections, has that been rising? Has that been less of an issue going forward, and kind of grabbed any rents that haven't been collected in the past compared to maybe the entertainment that have also been kind of lagging compared to other tenants?
Yeah, looking at, I think fitness got over 90% for the third quarter, and generally the trends have certainly been, they improved throughout the pandemic. Obviously, in certain parts of the country, you had a number of the capacity restrictions that were put in place. The encouraging thing for us, particularly from a boutique perspective, and I'll let Evie chime in here again, as well as more importantly, the low cost providers, that those traffic trends are starting to increase the quality of the franchisees that are opening new locations. These are multi-unit operators that may have come in and taken some struggling locations. What we heard from Exponential is some of the clubs that they took over during the pandemic, they're now selling those to operators that have 25, 30, 40 units, strong seasoned operators in a lot of these markets that are able to come in and take advantage of those traffic trends, having managed them before. So I think from that perspective, we've been really encouraged. And again, we think that low cost provider model complements some of the home fitness trends that you've been seeing emerging from the pandemic. So we've been encouraged by it. Evie, how about from your end?
Yeah, Brian, I think that there's pent up demand from consumers who are missing that community feel of participating in a class in person, and also a number of modalities like Rumble, kickboxing that you really can't recreate in your home. And so there's demand from those concepts.
And one of the surprises for us, actually, aside from the first couple of months in the pandemic, was how quickly traffic patterns picked up at the fitness providers. And as Brian mentioned before, particularly some of the lower cost monthly subscription models saw significant pickup, and that's been followed now by some of the small format players. And as Evie alluded to, we're seeing plenty of demand from those concepts, and they're being embraced by the consumer.
Thanks, Jim. Why don't we go to Mike next? Mike Miller.
Yeah, hey, Brian, you touched on this before, but the traditional mall-based tenants are used to reporting sales. So when you're bringing them to the portfolio and signing leases, what's the success rate you're having with getting them to report sales to you as well, where they would, at a mall down the road?
Pretty strong, I would say, across the board. Look, while as an industry, we don't get sales reporting as much as the malls, we've made a concerted effort to achieve that in our new leases going forward. And we're fortunate to have the folks on the phone that we do for places that we don't get reporting. Steve's got long-standing relationships. Evie, Laura do as well, where we can get a sense of what that sales performance is. So it's something we've been focused on. The other piece that's been helpful to us is that traffic data. We're finding a lot of consistency between traffic rankings, so we can see where that store ranks in a given market, state, across the country, and performance of the store. And we know that because the retailers are using the same vendors that we are for the information. So I think as we've gotten smarter about that, they've been more apt to both share and report. But specific to the mall-based retailers, because it's common, it's not as much of an argument. And believe me, it still is. I mean, they're not just giving us the sales at the start of every lease negotiation, but the team's done a really good job in improving that across the portfolio.
Got it. Okay, that was it. Thank you.
Thanks, Mike. Why don't we head to Samir?
Hey, Brian or Jim, I guess, can you talk about the economics today to get deals done? I mean, one of the things we had heard, costs are up all around, right? So, whether it's leasing, CapEx, TIs, I mean, how did those conversations go with the meeting, with the retailers that you met with?
Let me start, and I'll let Brian follow through on this. We actually disclose our net effective rents, and we've been very focused on the cost of new deals and working with our tenant partners through programs like taking the existing HVAC equipment, maybe not spending as much on the facade remodel or storefront, et cetera, as ways to be efficient and also speed the store to opening, which is a huge focus of these tenants. And so I'm real proud of how the team has performed there. And you can just look at our bottom, continue to grow our net effective rents, despite the difficult backdrop of supply chain disruption and costs that have gone up. They certainly have. The other comment I would make there is that, it matters where your rent basis is. So the fact that we have relatively attractive rent basis allows us to backfill tenants and still make money. If you're sitting on a high rent, your flexibility from a financial standpoint is severely limited. So costs are up, but I think we're finding ways to continue to manage that and still deliver good bottom line performance in terms of net effective rents. Brian?
And Jim, all I would, because of the demand and for space, we've been able to pass some of those cost increases on to. There were 2 instances just in the last month where Evie was able to go back to national retailers where we had a cost uptick and get that back in rent because they want this, because they have a large open to buy. So it's not across the board, but I think to your point, retailers are recognizing that costs are going up in some instances, and we've been able to either change scope to address some of those issues, which we talked about earlier, or go back and pass that on in rent.
And I guess just one more for me, if I may. Brian, you talked about the movie theaters where your exposure is pretty minimal. It's 2%. I mean, I guess what's the end game there, right? I mean, do rents have to get negotiated down at this point, considering that they do pay high rent and they have a pretty high occupancy cost ratio? So I mean, what's kind of how do you see that play out sort of over the next 24 months, you think?
Again, it's a very small percentage of what we do. Having said that, there can be challenging boxes to reposition. Oftentimes there may be an opportunity to take one of those down and replace the rent with multiple pads that are available there. So rather than chop off the box and create traditional retail, there's an opportunity to maximize value because of the fact that you're doing multiple ground leases on a location. But it's something that we've been obviously getting ahead of since the pandemic started in terms of what the demand is for a lot of that space. As I mentioned, the trends have been encouraging. I think in terms of some of you're seeing the anticipation for, say, the Spider-Man movie. You saw what some of the other Marvel releases had earlier in the year in terms of people going back to the theaters and more theatrical only releases. I think people have recognized that theatrical window is important to every other window that a release ultimately has. So those trends have been encouraging, but it's something that we've been very proactive on in terms of how to reposition those. It's expensive to chop the box up any way you look at it.
Yeah, and the actual theater concentration, Angela, correct me if I'm wrong, is about half of our entertainment, which was represents about 1% or so. And I think the end game is repurposing those boxes. The industry is showing signs of coming back, but I think there's just going to be a need for much fewer exhibition houses. And I think you're going to see a continued shift towards concepts that offer something in addition to the movie, brewery, restaurant, that type of thing. So it's part of a broader experience. And we're actually seeing those concepts coming back a little bit more strongly than the classic multiplex style format.
Thanks.
We do have a question in the chat, and it's, have there been any discussions with co-working facilities? We had a conversation with a large co-working operator, actually just ahead of the pandemic. It was this time 2 years ago at one of their facilities in New York. We think there might be some opportunity for it across the portfolio, but haven't advanced. I mean, it'd be fairly small in terms of what we think that component is. We do have some smaller office locations in the suburbs, for instance, second floor office, very few in like our Westchester properties and some dense suburbs where we've certainly seen somewhat of an uptick in terms of demand. We've had salon suites operators take some of that space. We've had some medical uses take some of that space, but haven't seen a material uptick from a outreach from co-working facilities as much. And then why don't we go to Linda?
Thanks. Jim, you just mentioned how costs are up in the context of building out boxes. On the demand side, did retailers discuss how inflation is impacting their cost of goods or capacity for consumers to absorb price increases?
You know, our discussions there, Linda, with the retailers to date have generally been positive in that they've been able to pass along much of those increases to the consumer. Part of what's benefiting them, ironically, is the disruption in inventory. So, you know, they're having to resort less to discounting, and they're educating the consumer, so the consumer is shopping over a much longer period of time than holiday seasons in the past. I think one of the actual interesting concerns some retailers have is, you know, will their buyers, as the supply chain gets healthy again, overbuy? Because this has actually been a very productive period of time for them. And I'm sure that will happen, right? And they will need to go back to discounting. But, you know, when you talk to the retailers, what they're particularly excited about is the growth in comps, not just off the pandemic, but where they're growing off of 2019. And, you know, they're seeing their sales comps up 10, 15, 20%. And that is something that the pandemic, they believe, has helped accelerate some of the trends that are benefiting their store models. So, you know, broad-based commitment to those forward store pipelines that, you know, stretch well beyond the next couple of years.
And then is there a consensus view on when the supply chain issues might start to moderate?
I would hesitate to wager that. I mean, you know, you hear some of them expected to go into now 23, but we'll see.
Thanks.
Thanks, Linda. Well, I think we've taken questions from everybody here on the screen. I would just add that we were sitting there at the end of the first day of the show, and Steve and I were talking, and he just said to me, hey, this exceeded every expectation I had of the show. If you look at the tenants who we showed on the screen, they had large contingents that were out there last week. And if you saw our booth on Monday and even some of the meetings our team had on Sunday, it was incredibly active. And so with the momentum that we had coming into the conference, as well as the discussions we were already having, to have that really kind of accelerate our plans into next year, it was really exciting. We got a lot to follow up on, some of which that we shared with you all today. So we appreciate you all taking the time to be with us today. We hope to be able to do this in person in May, as we were doing prior to the pandemic. But again, really excited that all of you got to spend some time with us and meet a broader contingent of our team who are really helping drive results across the portfolio. So we appreciate it. Hope all of you have a fantastic holiday, and we'll look forward to seeing everybody soon.
Thank you.